Are you looking to invest in 2023? For your information, the markets this year are probably going to be just as unstable as the ones we experienced last year, which means you should wisely invest. But how? You might follow the very principles and philosophy of Peter Lynch. The strategies of this true legend in the world of investments can earn you financial success this year. Here's how. Even the most novice investor should recognize the name Peter Lynch. You ask why? Because he has a storied 13-year track record of overseeing and dramatically increasing the assets of Magellan Fund, which is why he is such a renowned fund manager. Peter Lynch is the most well-known sage of the present-day financial world. You won't believe that during 1977 to 1990, he increased a $14 million fund to an astounding $18 billion. This really made him highly respected and followed by investors all around the globe alongside Warren Buffett. Lynch formed his investment philosophy while working at Fidelity Management and Research, where he also managed Fidelity's Magellan Fund, which helped him achieve substantial prominence. During Lynch's tenure, which started in 1977 with the fund's establishment and lasted in 1990 with his retirement, the fund consistently ranked among the top stock funds. Between 1977 and 1990, when Lynch served as manager, the fund continuously returned an average of 29.2% per year, making it the best performing mutual fund in the world. The S&P 500 earned less than half as much at that time as this. The assets under administration expanded over his 13-year tenure from $18 million to a staggering $14 billion. Lynch is convinced that utilizing his approach, private investors have a clear advantage over Wall Street and big money managers. His investing strategy has not only passed the real-world performance test, but it has also passed with flying colors. Lynch made his first profitable investment in the Flying Tiger, an air freight company, and his approach to investing has been praised for being adaptable to the economic climate at the time. He used this to pay for graduate school. He has managed money for years and feels that the majority of businesses fall into the following categories. First, slow growers. These are companies that are slow to grow but nevertheless pay dividends on a regular basis and are old and aging. For dividends, investors might put money into these businesses. Next, stalwarts. These are big businesses with 10 to 12% growth rates and returns that don't exceed 50%. Then, fast growers. These are small, highly risky, aggressive enterprises with forecasted yearly earnings growth of 20 to 25%. They are Lynch's top picks. Cyclicals. Most of these come from the auto, airline, and steel industries, whose rise and fall in sales and earnings are mostly predictable based on the economic cycle. A notification signal regarding the stock price is typically included with them. Turnarounds. Lynch referred to these companies as no-growers because a lot of them have a tendency to go bankrupt and then they come back stronger than before. Asset plays. Companies with high levels of assets that are frequently ignored by the market are considered asset plays. In turbulent market cycles, this kind may be able to self-revive. Now, what's his tips to invest wisely? Buy what you know. Lynch strongly thinks that if investors understand the business, its operating model, and its fundamentals, they may make wise investments. You will be able to think critically and choose intelligently when it comes to investments and returns as an investor if you do your homework on the stocks and the company that is offering the stocks. Lynch asserts that our eyes, hearing, and common sense are our best stock research instruments. Lynch took great pride in the fact that many of his brilliant stock ideas came to him when he was strolling through the grocery store or casually speaking with friends and family. When we watch TV, read the newspaper, or listen to the radio, we can all analyze what we are hearing firsthand. We might also be on the lookout for fresh investing ideas when traveling or driving down the street. After all, 2/3 of the U.S. gross domestic product is made up of consumer spending. Look beyond what is visible. Peter Lynch observed that during the gold rush, most would-be miners lost money. But the folks who sold them picks, shovels, tents, and blue jeans earned a good profit. You can hunt for non-internet businesses that tangentially profit from internet traffic today. As an investor, it's critical to look past the obvious. Although there are many companies working to boost the value of promising stock ideas, they are not the only ones. It is possible that by 2023, investments may start to appear in the portfolios of regular investors. Alternatives may reduce volatility brought on by inflation and recessions and boost returns more than dividend stocks alone because of their low connection to traditional asset classes like stocks and bonds. Consider mutual funds. When it comes to investments, mutual funds are a fantastic solution. Equity mutual funds, according to Lynch, are the ideal option for investors who want to buy equities but don't have the time to conduct their own research. Perhaps, if you are one of those investors who doesn't have the time or desire to independently investigate a company before making a stock investment, keep in mind that one of Lynch's signature success factors was the Magellan Mutual Fund. Over an extended period of time, mutual funds have historically outperformed equity mutual funds. Up-downs are to be expected. You shouldn't always expect to succeed as an investor. You will inevitably suffer losses. Peter Lynch once stated that in this industry, if you're good, you're right 6 out of 10 times. You will never have a 9 out of 10 chance of being accurate. Losses do not imply that you are a poor investor. If you invest in managed stock mutual funds, individual stocks, or even index funds, it is almost certain to occur. Invest for long-term. Long-term investments yield larger returns, which is one of Lynch's many wise words. In the absence of many surprises, he once asserted that stocks are quite predictable over 10 to 20 years. In order to determine whether they will be higher or lower in 2 to 3 years, you might as well flip a coin. He made investments but held onto his positions till he believed the moment was perfect. Furthermore, while deciding when to sell the stocks, Lynch did not attempt to forecast the direction of the market as a whole. Lynch once carried out research to ascertain whether the use of market timing was a successful tactic. The study's findings indicated that an investor would have made a compounded return of 10.6% over a 30-year period if they had invested $1,000 annually on the year's highest day from 1965 to 1995. A second investor would get an 11.7% compounded return over the course of 30 years if they both invested $1,000 annually for the same duration on the lowest day of the year. The first investor only behind in his returns by 1.1% annually after 30 years of the worst conceivable market timing. Lynch consequently thinks it is pointless to attempt to forecast the short-term changes in the market. Peter Lynch's success and stock-picking skills speak for themselves, notwithstanding the possibility that he over-diversified his fund. He mastered the art of observing his surroundings and comprehending the world both as it is and as it might develop in the future. By putting his teachings and our own observations into practice, you can invest wisely this year and make a hell lot of money.